Hello everybody. So today I want to make another video briefly about Tesla stock being down and Enphase stock being down. Although Enphase, it's not as surprising. We knew Enphase would roughly be down at least until the Solar Edge earnings are out. But Tesla today is down more than 5% now, and it's really odd and strange. And there's various rumors. I saw a rumor on Twitter saying that a 20 billion capital raise would not be a bad thing, and that they may do a capital raise. That's one of the rumors. Another rumor is that Elon Musk is selling again. Doesn't really matter. The market is extremely short-term, short-sighted, and the future is on sale today. So I just wanted to make a video to tell you the future is on sale today. It's cheap, and I just put quite a few orders for Tesla, and Tesla under 200 is a blessing. I am so pleased with that price, and I don't know if it will go back to 100 again. Right? It went down to 101 last Christmas. If every Christmas we're gonna get Tesla near 100 as a Christmas gift, it doesn't matter anything to me. It just it's just that if you're not in the habit of seeing red in your portfolio, it can be very painful, right? That's the whole idea of prospect theory. Is like seeing the green feels good, but it doesn't make up for the pain of seeing the red, if that makes sense. Like losing $1 makes way more pain, gives you way more pain than making even $3, right? That's the whole that's the whole thing behind prospect theory, and the whole reason why sometimes it's a good thing to put away the trading account, not look at the trading account, and like I said, go on a walk. And if you go on a walk, then you can really understand that 197 is a great price for these companies, because these companies have a bright future. They have a long-term bright future. It's will Tesla be the only survivor of car makers? Will there be just a handful of survivors? How many survivors are there going to be in the transportation sector, right? Transportation being, the second main expense of all households around the world. It's transportation, the second main expense, right? It's the second biggest expense. In the US, you have healthcare that's up there too, and education that's up there. But in the rest of the world, transportation is your second big expense after your house. And that's getting disrupted. And there's a player who has a 60% market share, and that is Tesla. And I know Tesla is going to be one of the survivors. I don't know. I think it's very unlikely that GM, that Ford survives. There'll be zombie companies. And the brands may survive, but there'll be zombie companies, and they'll just have injections and bailouts and more bailouts, right? And it's going to be a main player competing against companies that are going to get bailouts. And if you look at the performance, I'm sorry to be long term, but if you look at the performance right now with a depressed valuation in both Tesla and Enphase, and you go back to the maximum that this total return calculator goes, so the maximum for the comparison of these two stocks is 11.5 years. So if you go back to 11.5 years, you see that, okay, so Enphase is way more down than Tesla, relatively, just point number one. But then point number two is you see that the returns dwarf the NASDAQ. Like the NASDAQ over the long run is a 15% return. So even in Enphase, at this crazy $78 price for Enphase, even Enphase has an average annual return of 8% higher than the NASDAQ. And Tesla, let's not even discuss Tesla, right? Tesla is the best performing stocks of the 2010s. And in my view, it has not lost at all its competitive position, right? The competition has made no dent. There's no dent that has been made into Tesla by the competition. In fact, all of the competition is backing away from making electric cars, downplaying their plans. So anyways, this is an opportunity. I bought more. I bought more today. And if you have savings account type stocks, which if you've been a follower on the channel for a long time, you know that I don't believe in savings whatsoever. Savings are totally pointless. But I do believe in buying, say, a big tech stock And by the way, that's just entertainment, right? That's not advice whatsoever. But as far as our entertainment goes, like I believe using a big tech stock as a savings account is a great way to do it. So and any of the big five, right? Microsoft, Apple, Google, Amazon, any of these stocks. My big savings account stock has been Google for the longest time. Because it's kind of the most compelling valuation out of the five, and it's got a lot going for it. So it's always been my savings account, right? But this is a great moment when you have the delta between savings account type stocks and say a hyper growth stock like Tesla. Because if you look at, say, the delta between an Amazon and a Tesla right now, I'm thinking of it as a pair, you can see that your cost for Tesla, the cost of Tesla in Amazon shares, so you've turned your fiat money into Amazon shares and you use Amazon shares as a proxy for currency, you use it as a proxy for money, right? And you see that the delta between the two is more than 8% right now, because one stock is going up and another stock is going down, right? That begins to be meaningful. And so I've begun to liquidate one of my old Google positions, and also the Triple Q. The Triple Q is a great savings account alternative. No investment advice, but that's how I view these assets. That's how I view these assets, because they roughly match monetary inflation, which monetary inflation, in my view, is 15%. So when you have 15% monetary inflation, right, each dollars, there's 15% more dollars out there every year. If you have the NASDAQ who roughly matches that, then it's a savings account, right? You're not making any money on top of that. It's a savings account. It's a savings account. And anyways, I'm so happy to see Tesla in this price. I'm so happy to see Enphase at this price. How low will they go? I don't know. I don't know how low they will go. Gosh, I'm rhyming today. I don't know how low will they go, but I'll tell you one thing about the way I trade. And I buy stocks nearly every day, like at least 4 days out of the week, and the market is open 5 days a week. It's very rare that I will not buy stock in any given day. And I always want to be in this position because that's what I've found works with me over the years, over more than a decade of investing. When stocks are your passion, when they're your hobby, right? Somebody who doesn't like stocks, that makes no sense for them to make a bunch of tiny transactions. It makes absolutely no sense. But I remember the days when it used to cost $7.99 to do a trade, and I used to be upset because I couldn't do it just a little bit every single day because it didn't make sense. Now I do it every single day, right? It's my morning routine, and it's very tiny amounts, very tiny positions. But this is the way I do it. That's what I was saying. I buy every day. It's tiny amounts. But why do I do it like that? Because I'm paraphrasing Ben Graham. And he writes in old style, so it's always masculine in the way he writes. But, the active investor must occupy his hands. He must do something. That's the way I avoid making major mistakes and major move in the brokerage account, by always doing a little something. The investor must stay busy. He must be doing a little something, for otherwise his passion could consume him and make him do crazy stuff. Right? The last thing you want to do is you want to be not familiar with your brokerage account, and then you see the news on Twitter and you say, okay, I'm just gonna liquidate everything and make a stark move, make a big move, right? Like many people did. Many people did that with their retirement accounts in 2008, right? In 2008, you had plenty of people who were complaining, oh, all of my retirement savings are gone. Well, you know what? Your retirement savings were gone because you went into your retirement account. And of course, you hadn't logged in 3 years. So you're not familiar with seeing the red. You're not familiar with seeing those numbers. Those numbers that you see on the brokerage account give you emotions, right? They emote feelings in you. They give you emotions of anger or fear. And then because you're not used to seeing that number in the brokerage account and the number move up and down because this is not a familiar feeling, you end up selling your retirement savings at the lowest low. This happened many times in 2008. This happened in 2020. So that's just the way I do stock. It's like, I'm familiar. Now I'm familiar seeing the red on my account. Believe me, there's quite a bit of red on Enphase. There's no red on Tesla. Tesla has to drop quite a bit more for it to be red. And there's definitely zero red on Bitcoin. I don't think I'll ever see red on my Bitcoin again, right? Because that's the point of diversifying, right? You diversify your asset. Bitcoin is my second biggest position. Enphase is my third biggest position. Tesla is my first position. And at this rate, if Tesla keeps dropping, Tesla is now roughly 40%. If Tesla keeps dropping, Tesla will be a bigger position. But that's okay, right? I'm familiar seeing the red, then you get familiar seeing the green. And if you wait long enough, if you've had your broker, and you know this, like many of the viewers of the channel know this, if you've had your brokerage account for 10 plus years, in a long enough time frame, in a long enough period, make sure you tweak when you log in your brokerage account. Make sure you don't do beginning of the year. Make sure you tweak it to the time you opened the account. And when you tweak it to the time you open the account, you realize, well, wait a minute, it's just a long green journey. It's just a long bright green journey. That's what this journey of investing is. So this is the long run. We are doing this on the long run. The stocks are dropping. These future-oriented stocks are dropping, and there's great news out there. Like, you may have seen this. We haven't seen probabilities of a rate drop being placed in the CME Fed Watch tool. We haven't seen that in more than a year. But now we're seeing probabilities of rate drops, 1.8%. You may say, oh yeah, it's not going to happen. Well, yeah, according to the CME Watch tool, it's Fed Watch tool, it's not going to happen. But we're seeing these probabilities, being priced in. And you see March 2024, we have a 10% probability now priced in March 2024 of a drop in rates. And then in May, a 31% probability. And then right now in June 2024, CME Fed Watch tool is telling us rates are going to drop. Now, the more you look out, the more meaningless this gets, of course, and it's not very accurate over the long term. But we should be happy to see that these rate drops are being priced in. Because within a year, and maybe I'll bookmark this video for myself, within a year, interest rates will be down. And the narrative will be, okay, well, how quickly is the Fed going to drop rates? How many bankruptcies are we comfortable with? How many regional banks are we comfortable going out of business? How many, right? How many households losing their jobs are we comfortable with? This will be the discussion. And in my view, this will be a discussion in 2024 at the height of a political election. Right? So rates will go down. And if you even think about 2024, we know years in political elections, the stocks are always up. I covered this in a prior video. In 2024, it depends. If it's a Republican who's rumored to be elected, then the gains in the stock market in an election are something like almost 15%. And if it's a Democrat, it's 8%. But it doesn't matter. It always goes up in election years. Well, not always. No investment advice, but often. And we see some great news again. You may remember the narrative of this market when tensions, well, it's more than tensions, when the unfortunate events in the Middle East started happening about a month ago. You may remember everybody was saying, oh, oil is going to explode. Oil is definitely going to go to 100. I remember on Twitter, everybody was saying, oh, oil is going to 100 for sure. The Middle East tension is back. Even big names, big hedge fund managers were saying that. Well, no, we're down 8% compared to the beginning of that unfortunate event in the Middle East. We're down 8%. So oil's coming down because there are structural reasons for energy to come down. And why is this a good thing? Why do we care about oil going down? You may say, oh, the Fed excludes energy in their preferred metric of inflation. They don't look at energy. Well, yeah, the problem is that we still live in a world where the cost of energy is the main input in everything we do. So if the cost of energy is high, your food costs are going to go up. Right? Because your farmers, they are paying more for that energy, right? Energy underlies everything in the economy, everything we do. And so this is a great news over the long run to see the oil prices being down. This is a great news. Anyways, it doesn't matter. It doesn't matter because with current prices for oil, we are still seeing a disruption in the world of oil. And this is where I'll conclude, and this is a bit of a tangent. So forgive me for going on a tangent, but I want to talk about this tangent. Both Tesla and Enphase, and they're way down today. and they've been down this past 2 weeks. They sell products that require financing. And that's the narrative, by the way. That's just a narrative. This is true, but this is the narrative driving the stocks, right? There could be another narrative driving these stocks, right? There could be many other narratives there. I could easily imagine having a Tesla AI narrative another month driving the stock way up because of the AI narrative. And I could imagine a green transition or a green electricity narrative. Someone in the comment section said I didn't talk positively enough Enphase for the benefit that it does, for global warming and all of that good stuff. Well, yeah, these are investment trends. The narrative could be, we need to address, things like diesel or whatever emissions, and we need to burn less fuel, and therefore you would have a market bidding stocks that are green stocks again. This used to be a narrative many times. This has been a narrative for a long time. The green trade over green stock. This could be the narrative. Well, right now the narrative is not this. Right now the narrative is these products need financing. And because these products need financing, nobody's buying the product. That's the narrative. But financing costs will go down. There is no choice. The government needs to finance the deficit. Major companies need to refinance their debts that are maturing. And these were debts that were taken at near zero interest rates. And so they're going to have to refinance them. And if they refinance them at 6, 7, 8%, well, you quite simply have a bankruptcy because you can't pay that. These companies can't pay that. Companies never pay off their debt in general. They just roll them over and roll them over for the longest time. Roll them over. There's a lot of companies in real estate, but not only real estate, in insurance, in banking. There's a lot of in industry. There's a lot of companies that have debts that's going to be maturing in 27, in 26, and that will need to be refinanced. And these rates will need to be low, because if they are not low, there's going to be a lot of bankruptcies, and the regulators are not going to be happy with the bankruptcies, because don't forget, the Fed mandate is also full employment. That's also the other coin of their mandate. So anyways, that's the narrative right now. Interest rates is the narrative. But guess what? It doesn't matter. Over the long run, Tesla and Enphase provide money-saving products. They provide products that save tremendous amount of money. This is, I think, one of the underexplored marketing reasons for these companies. That's why I'm also happy that Tesla is starting advertising a little bit, because it's true that most people still don't realize, and it's actually less than that. I've seen a few reviews of people doing it at home for $5. Charging at home their Teslas for $5 and not $7. My own calculation is about $7. But they don't realize that charging an electric car mile for mile is roughly 10 times cheaper, between 7 and 13 times cheaper. It is cheaper to drive an electric vehicle. But no, it's not 15% cheaper. It's not 30% cheaper. It's one order of magnitude cheaper. One order of magnitude. So this is why this is catching on the world by storm. This is why electric cars are going to be the main thing in 2030, because nobody's going to be wanting to pay this much money for transportation. Nobody's going to want to spend this much on transportation, right? Transportation is seeing its costs being disrupted. And of course, Europe is leading the way in the adoption of electric cars, because they haven't been as lucky as America, and they haven't had the cheap prices that we have here in the United States. I have my family visit from France every single year. And every time I go to the gas station, they don't understand. They're like, I don't understand why is it so cheap. I still have a gas car, by the way. Unfortunately, my car is not that old. So unfortunately, I'm keeping it because I'm buying stock. But the point is, they're amazed by how cheap gas is in America, especially in Texas. It's dirt cheap. If you live in the US, you don't realize how cheap gas is. Gas is very cheap in this country. But even with gas this cheap in this country, it's only 10x. It's still 10x cheaper to buy a Tesla. Imagine in Europe. In Europe, you get a 20 or 30x cheaper. Furthermore, and that's why I put Enphase and Tesla squarely in the same bucket of the energy revolution, the electricity revolution, right? It's the same narrative for an Enphase system. I could have put a solar edge system. You see how all of the time we spent on this channel debating the technical differences between AC and DC, getting into the granularity. Mr. Market definitely doesn't get into that granularity. It's like just sell off solar bad, and then you sell off solar. Anyways, doesn't really matter what we argue. I mean, it's funny that we've spent. I remember responding to comment section, spending a lot of time arguing 3%. Like we argue a 3% efficiency difference between string inverters and microinverters, when the selling point of a solar system is overwhelming. You have a roof. That roof is sending you between 7 and 9 times more energy than your home could ever need. And that roof has shingles on it. Right? It's like just a black roof with shingles. And the sun is not being exploited. And today with Enphase, right, with $25,000 to $30,000, you can turn that sun on your roof into free electricity for 25 years. You spend the money, 25 to 30K, then you get free electricity for 25 years, a 15 to 25% ROI. By the way, a family, what I like to call the soccer mom example, which, you know, if you have a family, and in the US it's a common thing for the stereotypical soccer mom example to be at the gas station every other day. It's very common in the US. Well, if you buy an electric car, which in the US is going to be a Tesla because they have more than 60% market share, if you buy an electric car, from the moment you buy an electric car, those tanks of gas twice every other day, 3 or 4 times a week, those tanks of gas, they disappear. They're gone. They disappear because all of a sudden you charge at home, and it's much cheaper. So the same is true. The same is true for those electric bills. Those electric bills that are going up around the US. California. There was a bid from the largest utility in California to increase prices by 22% in California, right? Across Europe, electricity prices, they're increasing. Every time they increase, this ROI increases. And on the other end, we have solar panels, which get cheaper and cheaper and cheaper every year. The only component that is not getting cheaper is a microinverter. And that's why Enphase is holding firm on its prices. But right now, when I take a walk in my neighborhood, like I will do this evening, because the portfolio is way down today. So I'm like, okay, I'm gonna just have a little walk and think about something else. Well, I look around and I see very little solar. And in the US, solar is 4%, 5%. It will be most homes, in my view, most roofs, in my view, will have solar. Because it just makes sense. It just makes tremendous sense. Just like switching from the horse to the gas car made sense. Just like switching from dumping money into a gas car to using electricity and driving on the cheap. Right? And using electricity from your solar energy. Most likely, this is the convergence. There is a clear convergence between solar panels on your roof and electricity. Because if you combine both, right? If you put solar panels and you buy a Tesla, then all of a sudden it's not a $7 charge anymore. It's free. It's free because you just get a little bit of a bigger system. You get a little bit of a bigger system and you have just solar on your roof charging your car. So anyways, I'll finish with this and being more philosophical. Right now, this market is very short-term. Everybody's short-term. Everybody's focusing on today and tomorrow and what's going to happen. And is Elon selling? Is this doing this or that? What's the downgrade of that analyst? Because they followed other analysts who did a downgrade. And they were like, okay, well, I got to be close to my other analysts who didn't downgrade. So I'm going to downgrade too. But then at the end of the analyst report, I don't know if you've ever read an analyst report, at the end, they always say, our long-term thesis remains unchanged. But the part where analysts almost always say our long-term thesis remains unchanged never gets reported, just gets reported, Bird drops price target from 25 to 20. That's what gets reported. But if you read, you realize the long-term thesis and the short-term thesis are entirely different. This short-term consequence, these short-term movements that we see in these stocks are only a consequence of fiat. They are a consequence of fiat and a single man and his mood deciding the cost of money. That's the short-term. That is not human nature. That is not reality. In reality, we are much more long-term oriented than 6 or 12 months, right? That's Mr. Market. Mr. Market's short-term preference is not the natural human nature. It's not us, right? Human nature is by its very nature long-term. It's just the way it is. We're very long-term, right? We build houses that last hundreds of years. Even the D.R. Horton homes, which I just criticized in my prior video, even those homes are going to last at least 100 years, right? Codes are at least out there so that a home lasts 100 years. So we don't build homes out of cardboard. We don't buy cardboard furniture, as I joked in my last video where I talk about the long term, right? If we're all short-term thinkers, we would do these things, right? People still want to become doctors, architects, engineers, software engineers, coders. Nobody would do that if we thought like Mr. Market. Nobody would go to school. Nobody would work hard for these long-term objectives if human nature was that of Mr. Market, right? Nobody would have kids. Nobody would... that's a waste of time. Nobody would have a significant other. That's a waste of time, a complete waste of time. We would be all short-term thinkers. This is not human nature. When you walk around, when you look at the world, this is not human nature, right? This is not even the nature of companies. Companies do everything for the long term, and they operate to survive. It is Wall Street that treats them as short term and wants them to do short term stuff. But companies don't do that. And in fact, we see anomalies when companies do that. They're typically taken over by Wall Street, and we see these anomalies like corporate raids in the 80s. We see these anomalies of companies that are perfectly fine, and you have a corporate raider coming in, shutting down the business, selling all of the assets. And, all companies, if we're all short-term, if our human structures, if all of these employees that are working at these companies were all short-terms, the rational thing to do would be to sell everything you own, have the best quarter of your life, and then you have no company left, right? Or go see your family, start selling the house, start selling the toys, selling everything you own. You'll have the best financial year of your life. But then you won't have a life anymore. So we are not short-term thinkers. We are long-term thinkers. We are long-term thinkers. Even look at the age-old fashion, and this is like the last tangent of the video. Look at the age-old fashion of trying to lose weight. Why humans in every culture do everything they can to try to lose weight? Why would you want to do that? Right? Eating is fun. Having a nice fatty burger is very, very fun. But overwhelmingly, everybody tries to lose weight. Every human out there tries to lose weight. It's like a common theme in society for the longest time. Why? Because we are long-term thinkers. Because we realize that if we work hard, if we do all of these things, we succeed. And this is related to this. Tesla and Enphase are companies for the long run. They provide revolutions for us for the long run, not for the short run. And so these short-term price movements really don't matter. We are not going to stay still as a human species and stay in our old way and not move on to the new way. The new way is better, faster, cheaper, stronger. The new way always has a 10x component to it, as Peter Thiel really outlined really well in 0 to 1. If you look at 0 to 1, the new way always has a component to it that is a step change in technology that is much better, right? That's why we moved from monks copying Bibles and other history books to the printing press, right? The printing press was 1,000 times better. Right? That's why we moved from small shops, small artisans to manufacturing and industry. Like if you go back, technologies get adopted. We do not stay still in our ways. Technologies get adopted. These are short-term movements. As long as your living expenses are covered by your day-to-day activities, as long as you don't get too crazy with margin, right? Margin is a problem, or leverage of some kind. As long as you don't get too crazy, and if you use leverage, you use it in an anti-fragile way, right? You'll be fine. No investment advice, of course, but you'll be fine. That's my view. So I'm very happy to be buying Tesla at 196. Sorry for the tangent. This is a bonus video. I was just gonna do one video today. I do one video every day normally, not two, but this is a bonus video because it made me mad. You know, I started the day seeing SoFi up 14%. I'm happy. I see the day SoFi up 14%. The market starts to make sense, and then you realize, nope, the market still doesn't make sense. But the long term does, and the long term is bright. So, for the 5th time, this was not investment advice. This is just entertainment. I appreciate your likes. I appreciate you subscribing to my channel. Thank you so much for your support. Follow me on Twitter if you can. Have a wonderful, wonderful day.